Good afternoon, ladies and gentlemen. I'm Alex Pollock of AEI, and Charlie Calamiris and I organized this conference together, which we think will be quite an interesting event. And it's our pleasure to welcome you to a discussion of can committees create financial stability. We're going to begin with two distinguished keynote speakers. First will be Congressman Scott Garrett, who represents New Jersey's 5th District, serving since 2003. He's the chairman of the Subcommittee on Capital Markets and GSEs with jurisdiction over equity, fixed income and derivatives markets, and secondary mortgage markets, among other sectors. His legislative achievements include easing the burden placed on small business by the Sarbanes-Oxley Act and lessening reliance on credit rating agencies. Among many others, he's authored bills to improve oversight of the Federal Reserve and the SEC, and a current bill to increase the accountability and transparency of the Financial Stability Oversight Council, or FSOC, a key topic today. Our second keynote will be from Mike Piwowar, who is a commissioner of the Securities and Exchange Commission. Before that, Mike was Republican chief economist for the Senate Banking Committee and lead Republican economist for the 4 SEC-related titles of the Dodd-Frank Act, which you may have heard of. During the financial crisis, he served as senior economist to the President's Council on the President's Council of Economic Advisors, and recently he has raised some very pointed questions about the structure and functioning of FSOC, which I know he'll be glad to share with us. We're delighted to have two such distinguished, thoughtful, and involved speakers today. Our timing is tight. Each one will speak for 10 or 12 minutes, plus a couple minutes of questions. And Scott, thank you very much for being with us, and you have the podium.
Thank you.
Does it need to be turned on?
Hello? Yes. Yes. No.
Can the back of the can it happen? Step. And the important portion, and hopefully I'm clear on all those parts. So thank you. Did anybody get that? No, you got it. So thank you for the invitation to be here. Alex, thanks for the invitation and the kind introduction and the microphone that actually does work here, and to my colleagues and to Commissioner. Thank you for being here as well. Thank you. I'll be staying to hear your remarks as well. Thank you also for the great work that you have already done in your, I guess you'd say, an impressive start with your new tenure there, and I appreciate that. So, to begin, as you know, well, some of you know, about 2 months ago, I participated in another AEI forum where the emphasis also was on the Financial Stability Oversight Council, FSOC. And when you think about it, when you're talking about FSOC, there are probably enough times for forums such as this to do a number more of them, where in the summertime we could probably actually think about going away for summer camp for 2 or 3 months and just focus it entirely on FSOC, and we'd be able to fill up all that time. So it's appropriate that we're spending a little more time on this, or my speech is on this as well today. Most of you probably are familiar, as I go through these remarks, most of you are familiar with that old Hollywood maxim that sequels are never as good as the first time around. So this is my second time around. Now that's not always true. It is in a lot of cases. You had Godfather 2 in the one case, less so true with Teen Wolf 2. Then, of course, how many people remember Teen Wolf 2, by the way, in this audience? Yeah, I was wondering whether I should include that. How about Empire Strikes Back? You're familiar, Empire Strikes Back. That was a good sequel, as less so. Then how about Fletch Lives? How about this? This is a real general evaluation to this audience. No one for Fletch Lives? Okay. They do tell you when you prepare remarks, what have you, know your audience. So now I know this audience. No one is here is familiar with Fletch. How many people have Fletch, the original? Oh my gosh, what an audience. Come on. All right, now I know who I'm talking to. Anyway, my remarks from the previous attempt attempted to raise a number of critical questions regarding FSOC's governing rules and procedures for designating non-bank SIFIs, systemically important financial institutions. Currently, FSOC's operations are secretive, and members of the committee have been, quite frankly, uncooperative with attempts to establish a more objective and data-driven process with less regulatory discretion and arbitrary decision-making. So I thought I would take today to give an update not only on movies, but also an update on certain actions that have or have not happened since my last remarks on my last speech on this topic back in May. After that, I'll lay out a number of other reform proposals that FSOC should adopt before designating any new firms as non-bank SIFIs. So, to begin, 2 months ago, Chairman Jeb Henseling, myself, and the rest of the Financial Services Committee sent a letter over to Jack Lew, Treasury Secretary Jack Lew, over also to the Federal Reserve, Janet Yellen, also over to the SEC, Mary Jo White. And in that letter, we spelled out a number of serious concerns that we had with the FSOC's process and the apparent subordination to the FSB, the Financial Stability Board. And so we raised that out, and we also asked for a number of important documents from them, and also we asked for correspondence between the U.S. agencies and FSB that will allow us to better understand how and why the determinations of global systemic risk designations have been and are being made. And if this is the process to have any legitimacy, the Congress and generally the American public have the right to this type of information. That was a little while ago. Unfortunately, it seems to have happened so much with this administration. The Treasury Department is, once again, stonewalling and refuses to turn over any of these requested documents. This unwillingness only makes it more obvious to me that there is something that they are perhaps embarrassed about, or perhaps that they are simply trying to hide. But on a positive note, we are beginning to see more and more legislative progress concerning and trying to correct some of the major egregious problems with the SIFI designation process and the regulatory regime that will befall any newly designated non-bank companies. And I'm going to give you 3 quick examples. First, back on June 3rd, the U.S. Senate unanimously passed the so-called Collins fix, which addresses the fictional concern of the Federal Reserve that they somehow do not have the discretion to appropriately tailor prudential regulatory standards for non-bank SIFIs. When you think about the Fed, it seems like they always have discretion when they want to have discretion, but they simply don't have discretion when they say they don't have discretion. And so the passage of this bill by the Senate was, in one sense, since it was unanimous, groundbreaking on several fronts, not the least of which was we finally learned that the Dodd-Frank Act was not written on stone tablets from Mount Sinai. It is not sacrosanct. Yes, the authors and supporters of Dodd-Frank are, in fact, fallible, and they did not create the perfect bill. And so the Senate has finally agreed with that when they say now we can try to correct it. So the smooth passage of this bill through the Senate should also prove that necessary changes to Dodd-Frank can be passed without completely altering the entire foundation of the law. Now, the second legislative success, remember I said there was 3, was a recent markup in the Financial Services Committee of 2 pieces of legislation designed to allow Congress to better understand how FSOC operates and to slow down additional designations until more information comes in. The committee passed H.R. 4881. This was sponsored by Randy Neugebauer from Texas. And what does that bill do? That institutes a 1-year moratorium of any new non-bank SIFI designations. Also, the committee passed another bill, and that was H.R. 4387, and which increases FSOC transparency and accountability. Hopefully, both of these bills, now out of committee, will go to the floor soon. And the final of the 3, the final legislative success story, is soon to be introduced bipartisan legislation that Congressman Dennis Ross, along with Congressman John Delaney, and by doing it in this bipartisan manner, it's always better, and so I applaud my committee colleagues for working together to identify an additional areas of agreement that would reform some part of the Dodd-Frank FSOC problem. What will theirs do? Their legislation would make a number of significant changes to the process by which FSOC designate non-banks as systemically important. The bill would require more public disclosure of FSOC's reports and an analytical framework of designations. Additionally, it would offer companies potentially subject to designation an opportunity to take specific actions to alter their businesses in order to be designated in the first place. Also, rumor has it that the Treasury Department is so concerned, this is interesting, rumor has it that they're so concerned about some of these minimal requirements in these legislations going through that they have over there, Undersecretary Mary Miller is actually calling up members of our committee and making phone calls to members trying to keep them off of the bill. And to step back for a moment, this is somewhat amazing and astounding. If the Treasury Department staff and other FSOC member agencies would only spend as much time making their designation process more transparent and open to the public and objective as well, as they seem to be able to have the time to lobby us against making any of these, what most people in this room would agree are common sense changes, then Congress wouldn't have to be spending so much time making these common sense changes. And so the irony is, by having such a slipshod process and refusing to agree to any semblance of good governance procedures, the FSOC severely undermines the very regulatory governance structure that it claims to want to have and protect. They literally are their own worst enemy. And so we got those three bills out there, and I believe these bills are critical and important changes to the FSOC structure and process. More still needs to be done. Congress and the American people need to feel confident the FSOC is not completely political or making it up as they seem to go along. And so we have some additional proposals. What are they? Given that the experts we have here today on the panel and also in the room as well, I thought it would be helpful to go through some of this to get some of your idea and feedback later on. So let me walk through some of the additional proposals and the rationale behind each one of them. There's only a couple. First one, don't allow retirees and pensioners' life savings to be charged by the investment companies to bail out or to wind down a multi-trillion-dollar bank holding company if there's a failure. If any massive asset managers are designated as SIFIs, that manager's customers, and who are they? They would be the pensioners, the savers, the retirees, will potentially now be on the hook for bailing out the creditors of other SIFIs, including the too big to fail banks. And this is, I think we'd all agree, completely inappropriate, and we should take legislative action to try to remedy that. Next, before making any additional SIFI designations, there must be clear, specific rules adopted by the Fed that detail exactly what prudential regulations by any non-bank SIFIs that they'll have to comply with. Now, this is not just my idea. We can look to Chair White. Chair White agreed with the assessment recently when she stated, quote, "I, as the decision maker, want to know, so what is on the other side of a decision that I make? What are the effects of it? What does it actually accomplish in terms of the issues you're trying to solve for? So splitting my brain in half artificially is not something that I can do." So I think Chair White is onto something here. I think she's absolutely correct that we should not be designating new firms into a regulatory world and into a regulatory void at the same time. There must be a clear set of rules beforehand before they make those actual designations. Finally, another easy change is to require the FSOC members to actually meet directly with the companies they are considering designating prior to moving the companies to stage 3, the final stage of designation. Now, again, like a lot of other things I've said so far, these seem to be a common sense approach and it's already being done. If you thought it was already being done, you're wrong. It's not. Most principal FSOC members won't meet with the companies being considered until after their staff has already recommended that the company be designated. Now, this basically goes against all standards of due process, and that's the reason why I raise it here as something to be addressed. And next, we need the GAO, the Government Accountability Office, to tell Congress if SIFI designations have conferred a too big to fail status, has mitigated or exacerbated a designated firm's systemic risk, whether it's affected its funding costs or increased the likelihood of a potential bailout by the taxpayers. I'm worried then, in light of all this, that there will be many unintended consequences of SIFI designations. The largest of those concerns is that the designation of a firm as a SIFI will do what? It will reaffirm and further entrench the belief by other market participants that the designated firms are too big to fail. You know, we go in Title II of Dodd-Frank provides these designation firms a direct line of taxpayer-backed debtor-in-possession financing. Also, on top of that, there are rumors that a few designated non-banks so far that the funding costs have gone down since their designation, even though there is, at this point, no regulatory, prudential regulatory regime in place by the Fed yet. And finally, FSOC must establish a more clear process and timeline for the Fed and FDIC to review a designated firm's living will and resolve the systemic concerns. When a firm is designated, it then is required to submit a living will to the Fed, FDIC. And you think about this, presumably, this living will details the process and procedure for unwinding the firm in a non-systemic way. But this is where it gets tricky. Dodd-Frank also requires an annual review by FSOC and all designated non-bank firms. And so the annual review was included in the statute because the non-bank designated process is not supposed to be permanent. The process is supposed to be identify risk by the company, work to address and reduce those risks, and then allow the company to be released, if you will, back into the private market afterwards. So if you have a firm that has been designated and it has an approved living will that details how it will be wound down into a non-systemic way, then how can it still be designated as systemic after that? So this is, I hope you understand, clearly a contradiction that must be addressed. And so in conclusion, we have a long way to go then on all these points I raised before FSOC is ready for prime time. I still believe that it might be better for the FSOC to be solely an information sharing organization, and as it was originally intended. One last note. Since my last AEI speech on this topic, I brought these concerns I just raised here with several of the FSOC members I have in my office. And during those meetings, I've been really appalled at their inability and their unwillingness to explain to me why they voted as they did on the specific non-bank SIFI designation. If the FSOC does not have concrete standards to follow, then SIFI designation becomes an inherently political process, blowing in the wind, if you will, whichever administration is in place. And to show how far we still have to go then, the new Fed Vice Chairman Fisher gave a speech last week where he specifically advocated for not less or the same, but for more authority for the FSOC and for each regulator on FSOC to have a charge of promoting financial stability. Financial stability, that's a code for regulators to have a complete autonomy and unfettered discretion with no accountability to anyone. More and more then, it seems like the Fed's idea of financial stability is to have the entire financial sector under their bailout umbrella. This is completely wrong. It's a wrong approach. We should absolutely go in the opposite direction. Instead of making it easier to bail out failing firms and companies, we should take steps to limit the regulators' ability to bail out these firms and restore market discipline and remove the moral hazard. I thank you very much for your attention.
Thank you. I think we will not have questions. We'll have to save that for the third appearance of the Congressman on FSOC, and we're going to go ahead to Mike.
Great, thank you. And thanks, Alex, for the gracious introduction earlier before the Congressman's speech. Your fine scholarship and that of your colleagues here at AEI has identified many of the fundamental problems, as just did Congressman Garrett with the Financial Stability Oversight Council. And you have asked the insightful imperative question of whether it can actually be effective in fostering financial stability in the United States. I appreciate that you are focusing attention today on that important topic, and I hope that my brief remarks will spur discussion that will continue after we leave this room. I also want to thank Congressman Scott Garrett for his leadership in trying to bring accountability and oversight to the FSOC. And based upon the audience reaction to his speech, I've decided to cross out all references to Caddyshack 2 in my speech. So we'll just skip right over those. I will speak more about his FSOC reform efforts in a minute, but before I continue, I need to provide the standard disclaimer that the views I express today are my own and do not necessarily reflect those of the Commission or my fellow commissioners. Now, preparing for this speech, I thought a lot about what moniker I could use to best describe the FSOC. I thought I could go, well, why don't I use the acronym? I could go with Firing Squad on Capitalism, the vast left-wing conspiracy to hinder capital formation, the bully pulpit of failed prudential regulators, the Dodd-Frank Politburo, the modern-day Star Chamber. You get the point. There's countless of terms that I could use that are on the one hand appropriately pejorative and at the same time entirely accurate. For sake of clarity, I'll stick with references to the two sort of official nicknames of the FSOC, the Council or the Unaccountable Capital Markets Death Panel. I note that the materials for this event describe the Dodd-Frank Act as notorious. That is certainly true, but we could also use the same label for the Council, which has gained notoriety for, among other things, being unaccountable and non-transparent. At least with the Dodd-Frank Act, however bad it is, what you see is what you get. Unfortunately, the Council's discussions and actions are being conducted largely in the dark, as Congressman Garrett mentioned. Congressman Garrett, who you just heard from, has drafted a bill that would shine light on the Council's activities. I am wholly supportive of this bill, and I thank the Congressman for his continuing to push this issue. Within weeks of his bill being introduced, the Council, quote, clarified its transparency policy. Now, the timing is surely no coincidence, and Congressman Garrett is to be congratulated for getting the Council to actually do what it had been representing it would do for over a year. Nonetheless, the so-called enhancements were in actuality make only marginal changes to the Council's processes and do not alleviate my concerns about the lack of visibility into the Council's deliberations and decisions. The policy still includes a non-exclusive list of reasons to close a Council meeting, which gives the Council members freedom to make subjective determinations of when it is not possible or practicable, in their words, to keep a meeting open to the public. As many of you know, I've spent much of the last year trying to attend the Council's meetings as a non-participating guest. I'm very disappointed but not surprised that my requests have been rebuffed. But the fact that Congressman Garrett, a member of the House Financial Services Committee and chairman of its subcommittee on capital markets and GSEs, is also being shut out is shocking, appalling, and downright insubordinate. Even if its proponents might act as if it is not the case, the Council is subject to congressional oversight. In fact, Congress may be the only tempering force against the Council's regulatory overreach. I applaud the Congressman's resolve in challenging the Council's determination to remain unaccountable and potentially expand its jurisdiction to cover all financial actors. I have far too many concerns about the Council to touch on all of them in the limited time we have here today. In fact, compared to my list of concern, the colonists' 27 grievances against King George III and Martin Luther's 95 theses protesting clerical abuses seem remarkably terse. Today, I want to focus on just two related issues. First, the outsized role of the prudential regulators, especially the Federal Reserve, that they play on the Council. And second, the Council's apparent disdain for non-banking subject matter expertise. A simple counting exercise shows that the prudential regulators have 4 voting representatives on the Council, whereas the non-bank regulators each have only 1. To make matters worse, the Fed, on its own initiative, has expanded the prudential regulators' 4 seats at the table to 6. In addition to the Fed chairman, Fed Governor Daniel Tarullo and President of the Federal Reserve Bank of New York, William Dudley, regularly participate in Council deliberations. That President Dudley contributes is particularly troubling, since the New York Fed is not even on the list of member agencies identified in the Dodd-Frank Act. No wonder Congressman Patrick McHenry called Governor Tarullo and the Fed the alpha dog of regulators working on the Volcker Rule at a recent congressional hearing. I am particularly troubled by Governor Tarullo's recent speech in which he unabashedly suggested that there was, quote, a need to broaden the perimeter of prudential regulation, both to certain non-bank financial institutions and certain activities by all financial actors. Let me repeat that. All financial actors. Governor Tarullo emphasized the need for so-called macro-prudential regulation, which is a term that lends itself to bringing anything and everything into the prudential regulator's scope. Lest there be any confusion over the broad scope of this so-called macro-prudential regulation, Governor Tarullo reiterated in his speech last month that, quote, any firm whose failure could pose systemic risk is subject to prudential regulation, quite apart from its relationship with insured depository institutions, unquote. Governor Tarullo is clearly asserting the Fed's alpha dog role and issuing a call to action for the Council. Ultimately, though, through a macroprudential approach, the Fed would expand its reach by immediately pulling under its regulatory umbrella any firms designated as systemically important financial institutions, or SIFIs. In its attempt to gain authority over capital market actors, the Fed, through the Council, has been ignoring the talent and the skills of the hundreds of subject matter experts in each of the SEC's rulemaking divisions: investment management, corporation finance, and trading and markets. The prudential regulators on the Council have been proceeding as if they themselves are the ones who know securities markets and investment products best. The most obvious example is the Council's much-discussed hubris in releasing proposed recommendations regarding money market mutual fund reform. It would be comedic, if not in such a serious context, that it did so while publicly acknowledging at the same time that the SEC is best positioned to implement such reforms. Furthermore, at the direction of the Council, the Department of Treasury's Office of Financial Research, or OFR, published a document last fall that laid the groundwork for subjecting the asset management industry to enhanced prudential standards and supervision. If the Council has done one good thing, it is that they took note of the public comments submitted to the SEC, and I note that the SEC, we were the only agency to issue the study for public comment. And those comments were overwhelmingly critical, and the FSOC recently convened a conference that further explored the issues. If the Council was listening to the presentations at the conference, they will see what we at the SEC already knew and told the OFR repeatedly when reviewing drafts of the report, that asset managers are subject to an existing, robust regulatory regime that already imposes a measure of stability by providing investor protections and maintaining fair, orderly, and efficient markets. The SEC is not the only Council member whose expert views are being dismissed. The Council's independent member with insurance expertise voted against the designation of insurer Prudential Financial as a SIFI. One quote from his sharply worded dissent most succinctly describes his position. Quote, "The underlying analysis utilizes scenarios that are antithetical to a fundamental and seasoned understanding of the business of insurance, the insurance regulatory environment, and the state insurance company resolution guarantee fund systems," unquote. This is yet another example of the Council refusing to rely on subject matter experts when making its decisions. It turns out that deference is not a word in the Council's vocabulary. Now let's return to the role of the prudential regulators. In the corporate realm, Governor Tarullo now wants to consider how, quote, special, as he calls them, corporate governance measures may contribute to an effective prudential regulatory system. And they would be special indeed. As one example, in a recent speech, Governor Tarullo posits that we should supplement existing duties for financial firms and their directors to protect shareholders with, quote, duties to further the public regulatory objective, unquote. This would require amendments to state corporate laws and federal securities laws, which he acknowledges, but only as an afterthought. The SEC's trading and markets expertise is also being marginalized. In 2012, the Council made a recommendation regarding error control and risk management standards for exchanges, clearing firms, and other market participants in a high-speed trading environment. More recently, the Federal Reserve Bank of Chicago published a senior policy advisor's working paper, which makes recommendations for equitable trade allocation in a high-speed trading environment. Equity market structure is an incredibly important and complex issue, and I've been a champion of a comprehensive review of market structure, but this effort should be led by the SEC. In fact, Chair White has asked the SEC staff to consider whether additional changes to our regulatory structure for equity markets are needed and to make recommendations for Commission action. If the Council or the Fed has any views on this topic, I encourage them to submit letters to any public comment files that the Commission may open on particular market structure initiatives. I assure you that we will give their comments the consideration they deserve. With the Council's steady march, led by its self-appointed alpha dog, the Fed, into areas that are solely within the SEC's jurisdiction, I'm concerned that our mission to protect investors, maintain fair, orderly, and efficient markets, and promote capital formation is being compromised. I am resolved to defend our jurisdiction from the prudential regulators' Council-enabled turf war, but the prudential regulators are mounting a coordinated behind-closed-doors assault through the FSOC that is currently 6 times the size of our defensive team. That is why I will continue to fight for more SEC representation and less prudential representation, regulator representation in deliberations of the Council. That is why I will continue to support Congressman Garrett's determined efforts to make the Council more accountable and transparent. And that is why I'm extremely delighted to be here today as part of AEI's continued efforts to shine a light on the unaccountable capital market death panel's activities. I could say a lot more, but I'll stop here and thank you for your attention. I understand that we may have time for a few minutes for questions, and I'm happy to answer any if there's any time to allow. Thank you.
Thank you, Mike. What I'd like to do at this point is take two questions for Mike, and then we'll ask the Congressman if you'd be willing to take two questions, say, after that. Is that okay? Questions for Mike? Anybody? And one in the back here. Please wait for the microphone. Tell us who you are and your affiliation, and ask your question.
Dave Michaels with Bloomberg News.
Yep.
Commissioner, you criticized FSOC's recommendations on money market reform. You also talked about expertise in the domain of the SEC with regard to equity market structure and other issues. Commission still has not voted on final rules for money funds, structural reform for money funds. When is the Commission going to vote on that, and what will the rules look like?
Sure. So as you know, the chair is the one who sets the agenda for the Commission. As you know, and as you reported and others, that we're close to finalizing the rule proposal that was proposed before I came in as a commissioner. She said she wants to get them done this year, and so we're getting fairly close on that. And in terms of what the final proposal is going to look like, as you know, the staff works with the Commission and tries to formulate what the final rule proposal is going to be. You know that there's a number of options that were out there, including floating net asset value or fees and gates or some sort of combination approach for either all money market funds or some sort of subset of that. So if we move forward with final rulemaking, it's going to be some sort of version of what was proposed in that.
Thank you. We have one more question for Commissioner Piwowar. Did I have a hand here? Here, okay. Yes?
Hi. Sarah Lynch with Reuters. We've been waiting for a long time for the Treasury Department to issue a solution for the tax problem if you decide to float prime institutional funds, and we haven't seen anything come out. It's been silent. Have you received any assurances that this will be addressed? Because I recall, I think in January you had said that was a threshold issue for you.
Right. Yeah, for me personally, it is a threshold issue, as are a number of other things that I've said publicly as well too. I can say that the staff has been in close collaboration with the Treasury staff in working through a particular fix if we decide to move forward with a floating net asset value. And I don't want to front run the Treasury in terms of what that fix would be and then any sort of announcement that they would or could decide to make in the future. But we have been collaborating with them on that.
Right. Mike, thank you very much. Would you turn the name tag around then? We'll ask Congressman Garrett to come back and take a couple of questions to end this. Question for Congressman Garrett right here.
Depending what the difficulty of the question, I may.
Bert Ely, a banking consultant, and this will be a softball.
Okay.
What is your a hard ball inside the softball?
Well, it's like this. I don't know. Can you answer this one? I'll go to the next one.
No, but I'll ask the questioner to come to his question.
You've talked about concerns within the Financial Services Committee over the FSOC. What is your read in terms of what the thinking is over on the other side of the Hill? And if the House is able to get a bill out, what do you think its reception will be over on the Senate side?
Yeah. So as Mike was saying, the commissioner sets the agenda. So this Reed sets the agenda over there, and of course the agenda has never been one that's been on the same page as we have in our House as trying to make the reforms either on the Dodd-Frank legislation that we're talking about earlier. I was talking about earlier on this area as well. So I can never really second guess or even hope to guess where they are. Secondly, generally speaking, the thrust of our committee has been to try to move a lot of the bills out of our committee, as you probably know, in a bipartisan manner, right? Because we figure if we can get enough Dems on board that we can sort of throw it over to them and that they'll be have to take it up. If you watched, I'm sure you did, the hearing that we had just the other day, it's amazing just how far we are from the other side of the aisle in our own committee on some of these issues, and how they have to sort of skirt the truth, if you will, in some of their pronouncements to try to elicit the responses that they wanted from the panel. The point of all that saying is that we're not getting as much support on this as we would like, and so perhaps not going to have that strict grand bipartisanship that we would hope to on the legislation going forward, but we still strive, and that will not undercut our efforts by the least of trying to move it through the full committee and then for the House.
Thank you. Another question for Congressman Garrett. Over here, please.
One last.
This last one.
Okay, whatever.
Michael Misha with KBW. I was wondering about the change to the Collins Amendment. Do you have plans in the House to take that up, the Senate bill, or are you going to go off in your own way?
Yeah, so I can give you a definite answer on that one. That's like definitely like maybe. So, so we just had, just inside the story, so we just had our chairman's meeting, today's Tuesday, so we just had our chairman's meeting yesterday, and with Jeb and all the subcommittee chairmans, that issue was brought up, and so some of us have concerns on it, and they were raised as well. I mean, the concerns, I guess, are obvious, right? That on the one hand, on the one hand, you can just do this and actually get a win on some of these changes to address some of the problems that are out there, that we all see that are out there. On the other hand, it seems like, well, if you can get a win, potentially there are a number of other issues that we would say this may be the only vehicle to try to get those other issues tied to, and how could the Senate then not go along with what they just did in a unanimous manner on the Collins Amendment? So we have to take that in from a political basis. The other issue that was raised by some is that so if you do this clean or with add-ons, what does that do? What does that facilitate for the council as far as their designations going forward, right? Does that give them at that point well, I guess they always feel that they have a free hand to do whatever they want, but now they would even have a freer hand to do whatever they want, because now they can say, well, we can make designations of just about everyone from this size all the way down to the nearly SIFI designation level, because now we can craft it in any which way that we want to. So my opening answer of maybe is exactly where we are right now as to handling it. Yeah. Okay, thanks.
Scott and Mike, thank you very much again for being with us, and let's show our appreciation. I'll ask the first panel to come up, please. We will begin with panel 1, which is our panel on systemic risk. Some of you have previously heard me say, perhaps, that old Justice Stewart said he couldn't define pornography, but he knew it when he saw it. And with systemic risk, we can't define it, and we don't know it when we see it. And how good can a committee be at knowing systemic risk when it sees it, or perhaps at seeing it at all? So I have a little, I hope you can see this slide. This, it's called FSOC on guard for systemic risk. In this case, systemic risk, represented by the lion over there. All right, is systemic risk, by definition, perhaps, what we don't know? Or even better, what we think we know, but really we don't know it. For example, that house prices can't go down on a national average basis, or that central banks have achieved the great moderation, or that new techniques in risk management certainly allow higher degrees of leverage in the housing sector, or that government debt is risk-free, or that countries don't go bankrupt. For those of you who don't remember that one, that's what the chairman of Citibank said just before all of the sovereign borrowers in the developing world defaulted starting in 1982. Or that they aren't making any more land, so of course we can rely on its price, or that they aren't making any more oil, to take another historical case, so that we can know that its price will always be rising. Indeed, systemic risk is very largely about prices and how prices are set or how prices disappear. And it always makes me ask, well, how much can prices change? And the answer is prices can change more than you think. Prices can change much more than in your very worst case nightmare scenario. And then one day you will find out that they have gone down even more than that. A second problem I just want to touch on of any government committee dealing with systemic risk, a government committee like the FSOC, is this, that governments are themselves major creators of systemic risk, especially central banks, but not only central banks, also national treasuries, legislatures, clearly, departments of housing, government-sponsored enterprises, and all various arms of the government are creators of systemic risk. So how can a committee chaired by a principal government officer, like the Secretary of the Treasury, a highly political office, in partnership with the Federal Reserve, as our speakers said, and a committee, the rest of which is filled with government officers and employees, ever criticize themselves for what they are doing to create systemic risk, or see the systemic risk that they are themselves creating or proposing? So coming back to my slide, you might say that the lion in the picture might be a projection created by the fellows themselves who are on the truck. Well, our expert panel is going to explain all of these problems to us and tell us what to do. Let me introduce them in the order in which they will speak, which will be alphabetical. First will be Charlie Calamiris, the co-organizer of our conference. Charlie is the Henry Kaufman Professor of Financial Institutions at Columbia Business School and a research associate at the National Bureau of Economic Research. His research spans banking and corporate finance, financial history, and monetary economics, including his provocative recent book, Fragile by Design. He served on the advisory scientific committee of the European Systemic Risk Board. I'm sure you saw all the lions, Charlie, when you were doing that. And like me, Charlie thinks that decision makers might learn from financial history if they knew any. Second will be Jerry Caprio, who is the William Breaux Professor of Economics at Williams College, my own college long ago, and chair of the Center for Development Economics there. Previously, he was the Director for Policy in the World Bank's financial sector, where his research included establishing the first databases on banking crises around the world, which explained to us all how very many such crises there have been and how often they occur. And also databases on banking regulation and supervision. And Jerry has worked on financial system reform issues around the world. Next will be Asla Demigorj-Kund. Asla is the Director of Research at the World Bank, where she's also been Director of Development Policy. She's published widely on economics, regulation, banking crises, and financial inclusion, is the author of a World Bank report, Finance for All, created the World Bank's Global Financial Development Report, and directed the report, Rethinking the Role of the State in Finance. Asla, I agree that that needs a lot of rethinking. And finally, Alan Mendelowitz, who is a strategic advisor to Deloitte Consulting and a former chairman and director of the Federal Housing Finance Board. In 2008, Alan co-founded the committee to establish the National Institute of Finance, which succeeded in creating the Office of Financial Research as part of the Dodd-Frank Act. Previously, Alan was Executive Vice President of the Export-Import Bank and Managing Director at the General Accounting Office, as it was then, a much better name than it's got now. He has testified to Congress 145 times and met with me to discuss finance risk and uncertainty at least that many times. Each panelist is going to talk from 7 to 10 minutes. We'll give the panel a chance to interact and then open the floor to your questions. We're going to stop this panel at 2:07 and get to the second panel because we're saving 10 minutes at the very end for a special session in which you will all be involved, which Charlie will preside over. So with that, Charlie, you have the floor.
Thank you. And let me add my welcome to Alex's. It's great to see so many people here to talk about these topics. I think that the background to how this conference came about is that what we all noticed during the recent crisis in the U.S., and more generally, as some of the panelists might mention, the more than 100 major banking crises, an unprecedented pandemic of banking crises that have gripped the world for the past 3 decades. What we've noticed is regulatory failure. And that means regulators not noticing things going wrong very quickly, not doing anything to stop things that are clearly wrong in retrospect. And the other thing that's happened is an emphasis on systemic risk, not just individual bank risk. And I think that I would say those are 2 major trends since the recent crisis in the U.S. that have had massive effects on changes in regulation. And one of the things that I think is troubling, though, is that part of the reaction has not just been changing the substance of regulation, but dramatically changing the process of regulation in ways that depart, I would argue, quite fundamentally from things that we're used to in our democracy. And that, to me, is the troubling theme that really made me want to participate in organizing this discussion, and I'll try to talk a little bit about one example. My example is going to be the process of stress tests in the United States. And so let me just quickly talk about them. Are they a good idea? That is having a stress test as part of a regulatory process, which is new. We've just done it a few times over the past few years. Is it a good idea? If so, what should those stress tests be trying to achieve? What problems might they be creating, however? And what's the regulatory process that's going to make those achievements most likely and those shortcomings least likely? So this is a debate we should be having about stress tests as a process, not just their content, that's part of it. Okay, so I very firmly believe that stress tests are long overdue as a fundamental part of the prudential regulatory structure. The main reason is because one of the things we've learned is that prudential regulation based on book value accounting of equity and risk-weighted assets and focusing on the ratio of book equity through an accounting process determined, divided by some measure of risk-weighted assets, doesn't do very well. Now, why doesn't it do very well? First of all, risk tends to be mismeasured. And secondly, book capital tends to be mismeasured. And other than that, Mrs. Lincoln, how was the play? So why are they mismeasured? They're not just mismeasured randomly, they're mismeasured on purpose by bankers who are trying to ease regulatory burdens, but not just by bankers, also by regulators and supervisors who have strong personal incentives to understate losses and to understate risk. And there is a large literature, which some of my co-panelists have contributed to, on the political economy of regulatory processes that has highlighted the second incentive problem, not just the first one. And so we need to understand that capital regulation, yes, has failed to a large extent because of regulatory incentive problems, and that's one of the main motivations of stress tests, to create something that's more robust than these measures that are prone to bankers and regulators' manipulation. Another reason for stress tests is that they capture things about intangible assets of banks that aren't part of the tangible assets that affect book value of equity. I'm not going to go into that, but I would argue in some of my recent research that this is very important. Now, the problem, of course, is that stress tests can't really be part of the solution if they themselves depend on the same incentive problems of regulators and supervisors that are crippling the prudential standards for book equity ratios on a risk-weighted basis. In other words, if we have a process problem in regulation, we don't solve it just by creating a new vast discretionary authority for supervisors and regulators. That's pretty simple and pretty basic, I think. So we can be worried not only that stress tests might be ineffective, but that they might even be used as part of a political tool. Now, I'm not saying in the example I'm going to talk about right now that they were used as a political tool against Citibank recently, but I do want to point out some things that make us need to have a transparent and accountable process. We just witnessed one of the largest banks in the United States that was found to have failed its stress test, not based on any quantitative criteria. It passed the quantitative criteria in the stress test, but failed based on some sort of subjective smell test criteria that we can't really put our finger on, the Fed couldn't put its finger on, and that coincided with that same institution just within a few weeks or months agreeing to pay $7 billion on a lawsuit filed by our Justice Department. Banks are under huge pressure right now from the Justice Department. The threat of an indictment might destroy their business. So the relationship between the banks and the government is, to say the least, complicated. And the possibility of the use of stress tests as a tool to make banks more compliant with political objectives is very real. By the way, $2.5 billion of the $7 billion that Citibank has agreed to in its suit is being given to private parties. I find that very disturbing as part of a political process that's not even very clear at this point. We don't know who those private parties are. And we've had private parties receiving benefits from these settlements in the past. So I'm very disturbed. And at a minimum, given the power of these stress tests, we need to have transparency and we need to have accountable processes. And we don't have them right now. Stress tests are conducted entirely secretly. Why? Well, the Fed argues correctly that it can't just lay out the stress test model because in all of its gory detail, because then the banks might game the model and make the model less effective, less useful. But presumably that doesn't mean that we should do nothing to make the stress test process better. We should, and here's my list, limit regulatory discretion in terms of the kinds of things that can come out of the stress test process. Broad rules about what a failure of a stress test means, not this sort of indefinite possibility of hard failure or soft failure or all these other things. Too much discretion, too much latitude doesn't seem fair, and it seems to be making the system prone to abuse. There should be the disclosure of the model to some entity other than the regulator that's doing it. There should certainly be congressional oversight of stress tests. I would argue, and I'm going to let Jerry, I'm not going to steal Jerry's thunder on his discussion of the Sentinel, that we need to figure out something along the lines of what Jerry's been talking about that's going to create, and it's very difficult to create, an authority that's independent of the government but that has access to that information and can use it as an organization to hold the Fed accountable to having a reasonable stress test. Thank you. And that authority should be evaluating the model in some sense and criticizing in a constructive way the Fed's policies. And finally, I'd also point out, it's not that long ago that Hank Paulson convened a committee that concluded, just prior to the crisis in 2007, as I recall, that the Fed really isn't the authority that should be running the day-to-day supervisory and regulatory process of banking regulation, much less anything else. And I think that it's time for us to revisit that. Somehow we rewarded the Fed for its massive failures as a regulator, and I think that we need to be thinking more generally about the problems with the connecting the monetary authority with the regulatory process, which the Paulson group had concluded was a bad idea, as most countries had concluded just prior to the crisis. I'll leave it there. Thanks.
Thank you, Charlie. I'll only point out that historically, after every major failure of the Fed, it gets rewarded with greater power and prestige. One great paradox. Jerry.
Thank you very much. It's a pleasure to be here. So if one steps back and asks the question, well, where are we on financial regulation? I think it's easy to conclude that we're lost. There was regulatory failure clearly in the run-up to the crisis, and many of us are concerned that there's dramatic regulatory failure today. How do we get lost? We were coming out from in the 70s and 80s of a system of direct intervention limiting what banks could do, and moving on to a system of prudential regulation and supervision for the first time. And part of the process was we asked the wrong people. They didn't know which way to go, and so we got even more lost. The people that we asked were people who were used to looking at the banking system as a series of individual banks and generalized from one bank at a time reasoning to the financial system as a whole. The result today, I think, is that we're choking on complexity. And just like the former Soviet Union, where the approach to trying to replace the market started out very simple, make us so many tons of glass, that didn't work too well when the glass that was arriving at factories was in these gigantic cubes that you couldn't see through. And so then the next regulation goes out, well, we want so many tons of glass, but not thicker than so much, and then you get glass that's really thin and was all broken when it was delivered. It's hard to take the place of the market, and it leads to ever more complexity, or to use the phrase that the members of the Basel Committee use, which is the same phrase that Soviet planners used, they had to get more granular. They had to get in at a finer level of detail. So I think we need to almost start all over, rethinking regulation. I know Oslo is going to talk about some of the incentive properties. Everybody likes to talk about, well, what are the rules? What I want to focus on is a related problem of whatever the rules are, how do you get them enforced? Because the problem that we have over and over again is that the regulators are not enforcing those rules. Jim Barth, Ross Levine, and I wrote a book on this called The Guardians of Finance, but the book that might stick with you even more is one by Toby Moskowitz, a Chicago finance professor, and John Wertheim, a Sports Illustrated columnist, and it's called Scorecasting. And they have a few chapters trying to explain home field advantage. Why is it that in all sports with referees, home teams win more games than visiting teams? And I don't have time to go through the evidence. The answer is it's a psychological bias of the crowds on the referees. And one bit of evidence is that in sports, where they introduce instant replay, the home field advantage goes down or disappears. My favorite quote was 2 years ago from the Wimbledon final when Andy Murray was playing, and there was an absolutely outrageous call in his favor, and they're running the instant eye replay, and McEnroe's commenting on it, and the referee reverses his ruling before you can actually even see the result, and then you see clearly that the initial ruling was a mistake, and McEnroe's line was, well, with this type of accurate instant replay, you might as well call it right the first time. That's the bias that we'd like to see in regulation. If you're a fan of soccer, you were watching the World Cup. In the opening game of Brazil, the most valuable player on the field was the referee. There were so many outrageous fouls that the Brazilians were committing that were not being called. I don't know whether it was psychological bias, the ref was bribed, he was in fear of his life, but I want that type of activity, those incentives, I want them corrected. Actually, a couple of games later, the same thing was happening with Australia, and people were wondering, why is the referee calling in favor of Australia? And why are the fans so pro-Australia? Well, they were wearing actually the Brazilian colors. So I think They got fooled. This, of course, backfired on the Brazilians. They got so carried away with penalties that the Colombians finally took out their star player, which may have had an effect on them later on. But throughout the tournament, you also saw that the officials were chatting up the players. It was like they were in awe of the players. Walking off at halftime, it was like they were good buddies. All this goes on in soccer because it's one sport where there's no no review or instant replay except on whether the ball has actually crossed the goal. In finance, you need both some set of rules, but you need to make sure that there's some pressure on the regulators to actually enforce those rules in a sensible way. Regulators made bad decisions in the run-up to the last crisis in not enforcing rules. Some people say it was because of complexity, but ninja loans were not hard to see coming. Or go to other countries where there was no significant financial innovation. In Ireland, just astronomical growth, and the regulators were looking the other way. One bank that was growing by 40% a year over a 10-year period got a letter from the regulator saying, we're concerned. 2.5 years go by and the regulator's done nothing. So I think there are a number of clear examples where one needs to have some form of regulatory review. Jim Barth, Ross Levine, and I recommend setting up a Sentinel, as Charlie said, an independent agency that would have no regulatory power at all. It would just have the power of information. It would have access to all the information that the regulators have, and it would have the power to write an annual report saying, these are the systemic risks that we see out there, and here's what the regulators are or are not doing. So a Sentinel that existed in 2004 might have flagged the fact that the Fed had received a confidential FBI report at the time saying there was widespread fraud in mortgage markets and was doing nothing about it. Or an Irish Sentinel, and by the way, the Irish authorities now do have a kind of Sentinel. An Irish Sentinel might have flagged the fact that their regulator was sitting on his hands while they had banks growing at just phenomenal rates. Some people say, well, the FSOC or its supporting agency, the FSR, could be a Sentinel, but they obviously don't have the independence. We've had interagency financial regulatory bodies since the late 70s. When I worked at the Fed, I had to go to a couple of those meetings, and regulators never say anything bad about one another in those sessions. When we've presented the proposal for a Sentinel at different agencies, they've told us that they would never speak out. I'm confident if I walked out of my classes that I teach at Williams and tell the students, I hate grading, I'm going to leave it up to you, you guys decide what grades you should get, there'd be an awful lot of A+. So FSOC is not the answer. One needs to have much greater independence. There are a lot of operational problems that we can discuss with setting this up. There's obviously a lot of opposition to it. The banks don't want this to happen. They want the regulator to be passive. The regulators don't want to be accountable. They're human beings, and like all of us, they like accountability for somebody else, but not for themselves. But until you get that type of oversight of regulation, I think what we're going to have in finance is just what we have in soccer. Horrible officiating and no end in sight. Thank you.
Thank you. Osla.
Okay, thank you very much. It's a great pleasure to be here. Charlie asked me to talk about an idea that we have, incentive audits, which we put together in a working paper, and this is an idea that we've developed with my co-authors, Martin G. Huck and Barry Johnson. So I'm going to talk about that today, but I also want to say that our institutions, the bank and the fund, have nothing to do with that, and if anything, they probably very much disagree with what I'm going to say today. All right. We start from the premise that the global financial crisis really was caused by a breakdown in incentives. And clearly, broader macroeconomic factors played a very important role. But there is broad agreement that distorted incentives at various levels were at the heart of the crisis. So we started out from the premise that it's very important to reorient financial regulation to have at its core the objective of monitoring incentives on an ongoing basis rather than as an afterthought. So this is where we propose incentive audits as a tool. And certainly given the institutions we come from, we have international surveillance in the back of our minds, but you can think of it in terms of the domestic context as well. So the existing tools in monitoring financial stability have important limitations. So when I think about the existing tools, I have two things in mind. One is the macroprudential stress test, and the other one is the assessment of compliance with international standards. Macroprudential stress tests are helpful in facilitating the quantification of some of the vulnerabilities in the financial system, but they are also very much criticized because they fail to provide an early identification of vulnerabilities in tranquil times, and they do focus on observed risks and exposures and not on the underlying incentive factors that drive them. When we think about the assessments of compliance with international standards and codes, we do know that these are helpful in facilitating the discussion. They're good starting points. They're commonly used in all these financial sector assessment programs that the fund and the bank jointly do together. However, we also know that these types of assessments involve a lot of negotiation and compromises, and where we end up with tends not to reflect the truth, so to speak. And it's also true that international standards are not always optimal in national context, because oftentimes these standards are designed with developed countries in mind. And as Jerry mentioned, the international regulation and standards tend to have this tendency to go towards much more complicated rules and regulations that are not necessarily optimal in more simple contexts where the regulators and supervisors tend to have weaker capacity to monitor and enforce, and therefore even if the countries wanted to comply with them, it's not obvious that they should be complying with them in the first place. And it's also true that these standards do not examine incentive issues directly. And when we look at some of the correlations and the relationships in a statistical sense with compliance and how they are associated with the stability of the underlying banks and the banking systems, the empirical evidence is very much mixed. Indeed, some of my own research suggests that there is very little robust correlation with the extent of compliance with BCPs and bank stability in the international context. If anything, it's the disclosure or transparency that seems to have an impact, but even then it has impact only on subset of institutions, and the result is not very robust. So where does this leave us? This brings us to the whole notion of the incentive audit that we try to develop in this paper. And in a nutshell, the whole idea is to conduct these audits to identify misaligned incentives. So we do want to regularly and systematically evaluate structural factors that affect incentives for risk-taking in the financial sector. And these are supposed to cover a broad range of issues such as guarantees, safety nets, banking powers, relationships, structure of ownership and liabilities, contract design, tax incentives, what have you. So the whole idea is to eliminate excess risk-taking at its source. And the implementation, which I'll talk about in a minute in more extensively, this could be ideally, this could be potentially organized under macroprudential authority. Clearly, policy instruments needed are much broader than microprudential instruments. And as an organizing principle, this could also be something that could be incorporated into FSAPs because they don't necessarily need to be developed from scratch. So talking a little bit more about the shape that they would take, clearly this needs to evolve with experience and practice, but the whole idea is that an audit would consist of a sequence of analysis proceeding from high-level questions on market structure, government safety nets, legal and regulatory framework, to progressively more detailed questions that would identify the relevant elements or incentives, if you will, in the particular environment that motivate and guide financial decision-making. And depending on the stage of development and the structure of the financial system in a particular country, more prioritized assessment of incentives in certain areas can be thought of. For example, if market discipline is underdeveloped, greater weight could be given to the incentives and instruments of the supervisory authorities and the institution's internal governance and controls in mitigating risks. Or if you have greater market discipline and it's relatively more effective, then again, greater attention could be focused on the adequacy of information disclosures or conflicts of interest in the agencies that are supposed to do the due diligence, or ways of sort of curbing moral hazard. So just to finish again on implementation, it is very important to perform such audits regularly. And given there's always resistance to introducing something entirely from scratch, we also try to emphasize that these need not replace other parts of the assessment of vulnerabilities, but can complement them. Again, in the back of our mind, we have the FSAP process and the international assessments, and we believe such incentive audits would be a wonderful organizing framework to emphasize identification of perverse incentives. Now, at the national level, they could be used by macroprudential authorities as a complement to other instruments, but there I'm in complete agreement that obviously governance of the macroprudential authority is very important to make sure that the incentives of the authority itself is properly aligned, and that's what my fellow panelists have been talking about. Thank you very much.
Thank you. Alan.
There we go. The topic of this session is, can the committee prevent systemic risk? And that really has two separate questions built into it. One is, can anyone prevent systemic risk? And the second question is, if somebody can do it, can a committee do it? Can the committee make a material contribution? And so let's address the first question first. Can systemic risk be prevented? Well, I think part of the answer rests with how you view finance and economics. If you view finance and economics as an empirically based analytical discipline, then I think the answer is a qualified yes. Because if you look out there at the current state of data in the financial world, if you look out at the current state of analytics, the potential for improvement is breathtaking. And the extent to which we believe that, in fact, a better understanding, while I don't think we'll ever prevent systemic events, I think that better data, better analytics can give you more advanced warning and hopefully an outcome that is sort of less severe and less costly and makes more sense. So I think there's a qualified yes. And the reason why I say that the potential for improvement is breathtaking is that if you look at data in the financial sector, it's about the state where data in manufacturing was in the 19th century, when every screw had its own unique nut. And the consequence of that is that there was no information or understanding about nuts and bolts as to how much pressure they could withstand, and steam engines were constantly blowing up. You really read about that in the history. But, I mean, that was one of the consequences. And so the solution on the data front really is to transform financial data to take advantage of what's possible by the state of information technology today. If you look around the economy, you look at retailing, you look at manufacturing, you look at a whole host of industries, what you find is the most complete data collection and at the granular level, which has transformed the exercise and efficiency of business. And this, by the way, is true in national security, too. I mean, the NSA keeps track of every one of our phone calls, so be careful about what you say. And I think that this was the objective behind the legislation that created the Office of Financial Research. We were supposed to create two key reference databases. One was counterparty reference database, so that each counterparty to a financial contract had a unique identifier, so we'd know, in fact, what aggregations were possible and you could aggregate exposure. And then secondly, the representation of financial contracts in a standard way that supported forward-looking analysis. We're not there yet, but I'm happy to say that notwithstanding the fact that the statute hasn't been implemented fully in this way, on the counterparty reference database, the global LAI effort is in fact moving forward, and I think industry has provided a lot of support for the effort. And on the representation of financial contracts, I'm involved in a project, the ACTIS project, which stands for Algorithmic Contract Types Unified Standard, which in fact is providing the basis for representing all granular transaction and position data in a way that can be easily collected and analyzed. And when I say analyzed, it means analyzed in the way that finance folks look at contracts, which is starting out with state contingent cash flows and then doing the kind of analysis on value at risk, income at risk, liquidity, et cetera, all the things that go into sort of understanding what's out there. So better data is absolutely a sine qua non for making progress, and better analytics. I mean, one of the things that we have to think about is, are we there yet in terms of the analytical front? And the answer is absolutely not. Historically, what regulators looked at was backward looking, not very helpful. The presumption was yesterday is tomorrow. Not very effective when you're trying to avoid crises. The process of stress testing, I think, was an improvement over the sort of traditional way in which regulators looked at things. But the reality is that stress testing themselves leave a lot to be desired. One, there's the problems with implementation, which Charles talked about. And the second problem is that stress testing is really just a first-order effect. And in a crisis, contrary to what most economists like to think about, value is what's important. That's what we're looking for. The reality is, in a crisis, what's important is not how much you're going to lose, but how you and everyone else in the market is going to react. And in order to understand the dynamics of this, we need to move beyond just even stress testing to things where you can begin to understand the dynamic effects in a crisis. And at this point, the one thing on the horizon that's developing is the agent-based modeling. And for those of you who want to follow up on what the state of agent-based modeling is, Rick Bookstaber has a paper coming out in the near future from the OFR, and I highly recommend it because I think this issue of how people react to the dynamic effects in a crisis is absolutely critical. Now, on the other hand, if your approach to economics and finance is to view laws of economics and finances actually haven't been handed down to Moses on Mount Sinai as an addendum to the tablets, we do have a problem, because if you take that approach to economics and finance, you don't need to do any empirical work. You have the answer as soon as the question is provided. And the famous example of this, which I find an anomaly, because Alan Greenspan was, I think, the Fed chair who was closest to data and really understood data in a way that very few of his predecessors did. He famously said, well, you can't know what a bubble is until it's passed. And, we had a conference on that here, and I strongly objected to that notion because asset values in finance are fairly easy to understand. Asset values in normal time are a function of the cash flows that support the values in the marketplace. And when asset values become unhinged from the underlying cash flows, you have a bubble. And so I think that it's really critical to sort of understand that if we're going to make progress in this area, we have to do it with an approach that focuses on data, better data, new analytical approaches at all, and don't start with the assumption that we know all the laws and we know the answers as soon as the questions are posed. Now, the second question is, can a committee contribute anything? And you guys saved me a lot of time in terms of my discussion of what's wrong with regulation. You know, in my view, in a world that makes sense, for example, regulators, chief risk officers, C-suite executives, boards of directors should all be interested in seeing the same kind of data and analytics. Now, I don't think that they're going to reach the same conclusion because they work with different objective functions. But they should, as a starting point, start with the same data and analytics. The reality is that the regulatory burden in the financial world, in my view, is pretty much of a deadweight loss, because every financial institution has a regulatory compliance office, and their task is to make the regulator happy. Their responsibility is to avoid regulatory risk. And the analytics and the reports and everything that they produce is not used by the institution. And so I think that, you know, we should think about, you know, how to make regulation better, transformed, worthwhile. And I think that we have potential in the regulatory world to significantly reduce regulatory cost and improve the value and effectiveness of what's done by changing the data that I talked about earlier, and in fact, by rationalizing the regulatory process. There are some things you have to do with on-site supervision. You know, you want to see what the policies and procedures are at the bank. You want to see how staff are trained. You want to see how policies and procedures are implemented. You want to talk to board members to see if they, in fact, are engaged at the appropriate level with the things they should be engaged on. But none of this methodology, traditional on-site examination, is something that's suitable for staying on top of risk. Risk should be based upon, monitoring of risk should be based upon collecting granular transaction position data on an ongoing basis and monitored continuously. And I don't need to go into more defects with the stress testing stuff. I'll let go at that. So how can we use a committee, in fact, to advance this cause? Well, I think that the committee should be focusing on things like, you know, how do you transform regulation to reduce the cost and make it more effective? How do you transform supervision so you can reduce the burden and make it more effective? Secondly, you know, committees can benefit from things that are taking place in other areas. If you go over to the Pentagon is famous for doing after-action assessments of what happens in conflicts, and they're also famous for constantly wargaming with red team and blue teams. I think one of the greatest mistakes that the regulatory community makes is trying to come up with consensus. I think instead of having a committee trying to come up with consensus, the committee should be the forum for conflicting ideas and debates. For example, the Fed has a dismal record prior to 2008 when it came to forecasting what was going to happen in the economy. There was no internal debate. I can tell you that in the June of 2007, an economist in the macro group was tasked with writing the forecast for the next board meeting. That economist prepared a highly negative forecast based upon what was happening in the housing finance market. The draft of that forecast was passed out to the staff. The staff all read it, and then the head of the unit said, anybody agree with this? Nobody put their hand up. And the response is, well, we're not sending this to the board, and threw it in the garbage pail. What you want to do is you want to...
One minute.
Great. What you want to do is you want to use the committee structure to promote debate on the merits and the analytics and the data associated with things that are so critical to safe and sound macro policy and macroprudential supervision. I could add more, but my minute's up, so I'll let it go with that.
Thank you. Terrific presentations by the panel. I'm going to give each member of the panel, if you want it, 1 minute maximum to add anything or reply to somebody else, just in the same order. Charlie?
I want to just make one point that relates to some of the comments made, especially by Alan. You know, we have managerial accounts at every financial institution as well as financial accounts. They're not used in the formal regulatory process. As far as I know, they're not used in stress tests. And it's what defines the business line, not just the transactions broadly. You know, you have to cut it also to integrate the managerial accounts and to use them both to inform management better, because I think in some financial institutions maybe senior management would benefit from that, and also to inform regulators better about how to do stress tests on line of business basis, not just sort of thinking about tangible assets only. And I think that this is really the future of stress tests. I'll just leave it at that.
Thanks, Charlie. You make me think of the old joke that we have tax books to fool the IRS, regulatory books to fool the regulators, and management books to fool ourselves. Jerry.
Yeah, I would just add from Alan's point that on promoting debate, not stifling it, that certainly is the way that a Sentinel could be effective. It has no governing authority. It's like the group of experts that are put together after a plane crashes. They have the authority to write a report, but that authority ends there. So you want to have people whose expertise is unquestioned. They've got access to information, and they can write a report that stimulates debate, puts pressure on through that channel. I think it would be a step in the right direction.
I find myself in such agreement with my fellow panelists that in the spirit of what Alan said, I was wondering if there would be a panelist who would disagree with us. Or at least commentators. It seemed like it.
We don't let them in, and we throw their reports out. We'll see in the Q&A. Maybe we'll get some of them. Alan, a final minute?
Yeah, I think your notion of the Sentinel, in fact, is probably 99 and 44, 100% consistent with the statute written for the OFR. The issue is not the regulatory authority. The issue is implementation of the statutory authority in its full breadth. Specifically, the reason why the OFR has no regulatory authority, and the reason why the director of the OFR is a totally independent figure, but is only an ex officio member of the FSOC, is specifically for the reasons that you gave. The fact that if you have regulatory responsibility and you have to act on your conclusions, we have too many examples in which the requirement to act has stayed your hand. You know, what we told the Congress when we proposed the OFR was that what we wanted the OFR to be was the equivalent of a biblical prophet, someone speaking truth to power.
You can't do that if you work for the Secretary of the Treasury. All right, we're going to open the, we'll talk about that later. Again, we're going to open the floor to your questions. We'll start back here, and then we'll go here and up front. May I remind you to tell us who you are, what your affiliation is, ask your question. If you preface your question by too much statement, the chair will remind you to get to your question. Vern.
Okay, thank you. I got my hands on some documents from...
Got to tell us who you are, though.
Oh, I'm sorry. Vern McKinley. I'm an independent consultant, mostly for the IMF. I got my hands on some FSOC documents through Freedom of Information, and it was regarding someone from OCC. They were going to present before FSOC, and somebody was trying to, a senior person was trying to assuage them, and so their description of it was, don't worry, FSOC, it's very polite. That phrase stuck out in my mind. How do we get it so it's not polite at FSOC?
Somebody want to take that? Sounds like you, Alan.
How do we turn it into a cat fight, right? The answer is it's leadership and vision. You know, if the leadership of the FSOC creates an environment in which the highest value is getting to the truth, you get that kind of debate. We have Tom Lutton sitting here from the Federal Housing Finance Agency. I guarantee you, if he were tasked as the red team for a proposal presented to the FSOC, you would have an incredibly valuable and worthwhile debate, and that would advance the movement toward the truth. It's a question of leadership and defining the objectives. If the vision is getting to the truth, you can do it. If the vision is not to make any waves, you know, reach consensus, ain't going to happen.
Jerry.
And you need more information about what's going on in those meetings. That will put some pressure on, I think.
There's another motivation you can have, Alan, which is to advance the agenda of whatever administration happens to be in office at that point. Bert, and then I'm going to come to you.
Bert Ely, banking consultant. I'm in the process of forming the International Association of Regulatory Arbitrageurs, and everything I'm hearing here is music to my ears. My question for you all is, you talk about all of these additional regulations and complexity that you want to introduce into the process for highly regulated institutions. At the same time, how are you going to put my prospective members out of business, or are we going to see an even greater growth in regulatory arbitraging and shadow banking and all of the problems that that creates?
Charlie.
Well, that's a big question, Berta. So I have refrained, given how disciplining I know Alex is, from talking about a whole platform of proposals I have, which I call an incentive robust program for regulatory reform, which I think we can build a regulatory system very different from the one that we have right now that would be far less susceptible to this arbitrage problem. But I was just focusing today just on the stress test piece of that. And I do think that it's not about making regulation more complex. If you're hearing this group saying they want to make regulation more complex, then you're not hearing what I'm hearing. What I'm hearing is wanting to make it more accountable, wanting to make it more effective, and I would say less political. And those are not making it more complex, in my view.
Well, my name's Steve Einhorn, and I'm just a supporter for AI, which I think is a terrific organization. Also, I want to thank the panel for what you've done. You've had good ideas, and also you've been speaking clear English, which I appreciate there. I've been told there are no bad questions. I have two bad questions for you. We're talking about systematic risk, and I want to go into a more broad picture of Dodd-Frank. You've brought out a number, directly and indirectly, of the unintended consequences of Dodd-Frank. As a businessman, I don't like a lot of the intended consequences of Dodd-Frank. So I wanted to ask you each if you would consider just briefly answering the question of what would be what's your major justification for terminating Dodd-Frank or let's say repealing it. The second question is, if we're really concerned about risk, about systematic risk, and it's a legitimate concern, then why not just either reduce the size of the companies so there are no legitimate systematic risk, or in certain cases allow for bankruptcies where more competent people would take over the pieces?
Okay, thank you. There are two questions. Anybody want to address one or both? I think you're called on, Charlie. Oh, Jerry, you want?
I'm not going to take the whole thing. It's too big a set of questions, but I would say that, so I'm against breaking up the banks, at least at this point. I don't think that, I think there are better ways to address problems of systemic risk than to take the banks apart, and I think that there could be significant costs in doing that. So I'd like to see if we can't still have an American global banking system before we decide that we can't, I think. So I won't take the very attractive bait of talking about all the things I don't like or my least favorite thing about Dodd-Frank, but I would say this about Dodd-Frank. I think that the fact that we are sitting here with this SIFI status without any objective criteria for it is just crazy. A bipartisan group of people at the Pew Trust that many of us sat on that was parallel to Dodd-Frank, we actually did come up with the idea too that it might be useful to have a designation, something like a SIFI. But it was absolutely crucial in our thinking that it would have to be something that was based on objective criteria that would help to create safe harbors that would encourage firms to be less systemically risky. That would, part of the whole goal of creating a SIFI status should be to encourage firms to be less risky. So the notion that we've created this sort of wizardry about systemic risk makes you a SIFI, but we're not going to tell you what that is just beyond ridiculous.
Other comments? Alan?
Yeah, I think if the FSOC is supposed to be looking at systemic risk, there should be some metrics out there. They should be able to track how they're doing, and they should be able to demonstrate progress. I certainly am suspicious enough of simple models that I would hate to take one metric and suddenly have that become the measure. But, you know, there are 4 different Federal Reserve banks that have come up with systemic risk indices. There are other research who have come up with systemic risk indices. So I think in the interest of not just bringing transparency, but bringing accountability, having some kind of, you know, empirical representation of how you measure these things would be a big step forward. Secondly, on the issue of Dodd-Frank, I have to tell you, if OFR were implemented consistent with the intent of the statute, you could do away with all the rest of Dodd-Frank and everything would be better. I told the members of the you know, the banking committee, I said, look, if it's a choice between OFR without the rest of the bill or the rest of the bill with OFR, we're better off with just the, you know, our proposal for the National Institute of Finance.
But you were proposing something which in fact is very much like what Jerry calls the Sentinel. It's the same idea. Let me just add the biggest SIFI, which creates the most risk, is of course the Federal Reserve. And the reduction to absurdity of the SIFI process is that Fannie Mae and Freddie Mac have not been designated SIFIs, which can only be explained by the politics of the organization. I had more questions here. Yes?
Yeah, I'm Stephen Lee with Global Client Consulting. And one question which I have is the remarks about systemic risk. Question is that should it be managed? Can it be managed? And if so, just how it's going to be done? The idea of systemic risk is kind of like the analogy is the internet. We have the use internet. How do you manage to use internet? How do you prevent abuse and problems and major dislocations of the intended purpose as the majority of people see it? And I think the systemic risk is much like what we talk about, a major dislocation of an event which many people are watching. I think we have think tank groups like the AI and many others who have identified many of these events even ahead of some of the problems we encountered in 2008. And the question, of course, is, are the regulators going to be able to do something about it? And the question is, do we currently have processes to harness all this insightful thinking that people have to make it so that some of these people who are responsible for being able to really act rather than just report on the issue, do something about it?
Okay, and that's going to be our last question. Anybody want to, how do we harness all the wonderful ideas we have to improve the world? You want to say, Alan, Jerry?
Yeah, just something quick, and that is, I'm very sympathetic to the critique of capital adequacy regulation. There are so many weaknesses in it. When I was at the Federal Housing Finance Board, it was right after the Gramm-Leach-Bliley had been passed, and there were provisions in the most recent legislation related to home loan banks that moved the banks to a risk-based capital system. And it got implemented, and I didn't find a single bank that had a risk-based capital requirement that was more than 1/3 of the leveraging requirement that was imposed by Jim Leach at 1 minute to 12 when the legislation passed. And I used to get up every day and say a little prayer of thanks to Jim Leach for having put the leverage requirement in, because I just didn't trust the risk-based capital requirement. So the answer is the extent to which Dodd-Frank has focused on things that are critical in a crisis, which is leverage, which you can't manipulate the way you can manipulate risk-based capital, and liquidity coverage. This is a start of looking at things that are actually important to make SIFIs, in fact, less risky and more resilient. More things can be done. For example, we have a tax law that reinforces fragility in the business world. The fact that you deduct interest payments on debt from your taxable income, but not dividend payments, provides an incentive to leverage up. If we change the tax law so the incentive to leveraging up associated with the disparate treatment of interest versus dividends that would make a contribution. There's so much that can be done. You know, if the FSOC were much more expansive in the things that are looked at, it could come up with a list of these things. You know, there is no such thing as Republican risk and Democratic capital. In the world of finance, you're dealing with data and analytics. And if there's ever a place where you can develop some kind of bipartisan consensus, it should be around things like financial stability and you know, trying to deal with disruptive things in the financial sector that, in fact, are a result of what the government has done in you know, multiple areas.
I'd like to thank the panel for a terrific job. The second panel should come up. Charlie, you move one chair this way.
Let me welcome everybody up to the podium. We're going to not have a break. If you need to take a break personally, you can do that on your own time, and we're just going to proceed right ahead. I'm going to, I was going to, yeah, alphabetical, pretty much. Well, while we're waiting for Peter, let me introduce the second panel. Oh, here he is. The idea when Alex and I put together this conference, the idea of the two panels was thematically to divide a little bit between theory and practice. That is, you probably noticed that the first panel had people who have spent most of their careers trying to come up with frameworks, big ideas. Not that the people in this panel haven't spent their time trying to come up with big ideas, but they've also had particular experience in the trenches. And so this was a trench warfare version of the panel. I'm not going to try to give you an introduction to all of these people and all that they've done, but I want to introduce them from the perspective of the various trenches that they've been involved in and are currently involved in. So starting to my immediate right, John Davidson, currently head of operations at Citigroup, compliance I meant, at Citigroup, and has had a career where he's really seen the financial plumbing from a whole variety of perspectives, including a long stint at the Chicago Mercantile Exchange, at Morgan Stanley, particularly with respect to global equity clearings, and now, of course, in a very low-stress job of trying to figure out compliance for this little bank in New York that hardly has any operations anywhere else, right? Right. To his right is Paul Kupiec, and Paul's here at the AEI, but his career, which you can read about in the folder, spans many years at a lot of different institutions, and most recently at the FDIC, which, of course, has been getting quite a lot of attention because the powers of the FDIC have expanded to now be involved in resolution of a much more ambitious type as codified under Dodd-Frank. And Paul was there during that whole discussion. Peter Wallison. Peter Wallison not only is a starry-eyed academic type, but he also has spent many years in the trenches of not just the government, but also in the private sector, acting as a lawyer specializing in the financial sector. And to his right, Ernie Petrikas. Ernie was both at the New York Fed as the chief counsel there. He was also chief counsel to AIG, and now he's running, I guess, the White & Case financial practice in New York. He was also, by the way, very instrumental in the ISDA derivative standards. So these are people who've been around for a long time and been involved quite a bit in the trench warfare of financial regulation. And I think that if we're going to talk about regulatory process and the kinds of things that are on their minds, it seemed like it made sense to devote a whole panel to that. So we're going to have practice now following theory. We'll do it in alphabetical order, since that's non-biased in some sense. Peter looks at me and says, no, it isn't. And so we'll start with John Davidson. And remember, you have no more than 10 minutes, and I'll ding after 9, so you know.
Great. Thank you very much, Charlie. My remarks today are an expression of my personal opinion and do not represent the opinion or the policy of Citigroup or any other organization with which I have affiliation. And just to manage expectations, I'm not going to talk about or answer any questions about CCAR or the Justice Department. This afternoon, I will ask you to imagine a much simpler approach to regulating the banking industry than the 848 pages of the Dodd-Frank Act and its 398 separate rulemakings, each themselves quite extensive. An approach that has the possibility of promoting both good behavior and financial stability. My focus today is to make some simple suggestions on how the regulation of the financial services industry could be improved upon. We must first recognize that the job of a financial regulator is extraordinarily challenging. Regulators have no upside. At the very best, nothing goes wrong. Their actions are always evaluated with 20/20 hindsight. None of the could've, would've, should've commentators are actually in the trenches when the fighting was the heaviest. Regulators share many of these characteristics with compliance officers. But unlike regulators, chief compliance officers have personal liability for their actions and inactions. The second thing to recognize is that we need to distinguish between regulating safety and soundness and regulating conduct. They are not the same, and indeed, outcomes that enhance one may be at odds with outcomes that enhance the other. The creating of the Consumer Financial Protection Bureau, in creating the Consumer Financial Protection Bureau, Congress recognized that in extremis, customer protection and safety and soundness preservation may be in conflict. The U.S., in my opinion, should strongly consider following the model of our colleagues across the ponds. 2 and only 2 financial service regulatory agencies, 1 responsible for conduct and 1 responsible for financial stability or safety and soundness. In the United Kingdom, the conduct of all firms is overseen by the Financial Conduct Authority, while the Prudential Regulation Authority acts as the prudential regulator for systemically important authorized firms. Likewise, the Australians have implemented this model, with the Australian Securities and Investment Commission responsible for financial market integrity, business conduct and disclosure, and consumer protection in the financial system, while the Australian Prudential Regulatory Authority is responsible for the prudential supervision of individual financial institutions and for promoting financial system stability. The third thing to recognize is that we need universal registration for all actors in the financial services industry. Why is it that to act as an intermediary in penny stocks that have virtually no consequence to anything at all, you need to be registered? To act as an intermediary in pork belly or lumber futures, you need to be registered. But to act as an intermediary in foreign exchange or interest rate swaps, you do not. The advantages of a universal registration system are a minimum level of training and competency can be required in an easy-to-demonstrate manner, a database accessible to both the public as well as to prudential employers can be kept of findings of violative conduct against registrants and even causes for the termination of their employment. And finally, it enables people who have engaged in severely violative conduct to be banned from the industry for life with appropriate due process. The fourth thing to recognize is that we need to regulate activities, not just entities. The current system focuses on the regulation of entities. So a person at a hedge fund engaged in exactly the same activity as a person at a bank faces a much different regulatory environment. Economists and business people think of the world in terms of activities, not entities. A focus on activities that need regulation would produce a much more level and easy to comprehend playing field. When a police officer pulls you over for a sobriety test, she does not inquire if you are organized as a subchapter S corporation or an LLC. The only thing that matters is your behavior. A focus on activities would also enable a more efficient allocation of capital among the various parts of a bank holding company. The fifth thing to recognize is that neither a supervision model, typical of safety and soundness oversight by bank regulators, nor an enforcement model, typical of conduct regulators such as the CFPB, the SEC, and the CFTC, can work by themselves. Strong incentives for self-policing need to be developed and implemented. There is a precedent for this approach, both here and abroad. Self-disclosure is considered a mitigating factor by the U.S. Department of Treasury's Office of Foreign Assets Control, or OFAC. OFAC administers and enforces sanctions programs primarily against countries and groups of individuals such as narcotics traffickers. The Obama administration is utilizing sanctions as a key tool in advancing U.S. foreign policy. The maximum civil penalty that OFAC can order is the greater of $250,000 or twice the value of the transaction at issue, and the maximum criminal penalty is $1 million. The benefits of self-disclosure are that it reduces by 50% the statutory maximum that OFAC can assess against an institution. It correlates to cooperation credit that OFAC can provide to an institution, further reducing potential penalties. It builds trust and confidence with OFAC because it's fully transparent, and it brings to OFAC's attention apparent violations of which it would otherwise have no knowledge. To help combat anti-competitive behavior, the European Commission established a leniency program. The program offers companies involved in cartels either total immunity from fines or reduction in fines if they self-report and hand over evidence. The program's purpose is to encourage cartel members to confess in order to beat their fellow conspirators to the enforcer's door. The first to report information that enables the European Commission to launch an inspection and find infringement is guaranteed total immunity. The largest fine imposed on a single company in this jurisdiction is over 896 million euros. Avoiding such a fine is clearly a significant incentive to self-report. Since 2005, 77% of cartel cases decided by the European Commission were initiated by such immunity applicants. Thus, in my personal opinion, I would again like to emphasize that these are my personal opinions and not those of my employer. Better regulation of the financial system could come about through, first, distinguishing between safety and soundness and conduct regulation and having a single regulatory agency in the United States for each. Second, implementing a system of universal registration. Third, regulating activities rather than entities. And finally, enhancing the incentives for self-policing. The great Chinese philosopher Lao Tzu wrote, "Manifest plainness, embrace simplicity, reduce selfishness, have few desires." Wonderful world for the financial services industry. Thank you.
And thank you very much, John. Let's turn now to Paul Kupiec.
Thanks, Charlie. When I was getting ready for this panel, I was sort of kidding Charlie and Alex and asking them who on the panel was going to support the FSOC. I didn't think there were members that were going to be strongly supporting. And I said, And they said, well, we're not really sure what people are going to say. And I said, but if there's nobody on the FSOC side, that's not really fair. And I might just take the FSOC's side of point of view here and defend them for a few minutes. So let me start and let me first say some positive things about the FSOC. So if you take a look at the Dodd-Frank Act, I mean, the purposes and the duties of the Council to identify risks to the financial stability of the United States that could arise from material financial distress or failure or ongoing activities of large interconnected bank holding companies or non-bank financial companies, or that could arise outside of the financial services marketplace. I guess that's everywhere, right? B, to promote market discipline by eliminating expectations on the part of shareholders, creditors, and counterparties of such companies that the government will shield them from losses in the event of failure. And third, to respond to emerging threats to the stability of the United States financial system. Now, when you look at these things, I think these are all, you know, pretty noble goals. So that kind of ends my positive part. So now I want to go on to talk about what's really wrong with the Dodd-Frank Act. Now, the problem, the basic fundamental problem with the Dodd-Frank Act is, and Charlie says I'm a guy from the trenches, and I've worked in the trenches plenty, but I'm a guy who writes theory papers every once in a while too, and he kind of forgets that. So one of the problems with the Dodd-Frank Act is it forgets that financial intermediation is linked to economic growth. If you stop one, you stop the other, and Dodd-Frank forgets that. Now, you might use, oh, that's oversimplistic, but Asley knows this from the country she goes to. And if you go to a country that has just a banking system, nothing else, right? And maybe it only has one or two banks. If the bank gets in trouble, well, what does that bank do? Well, it takes the savings of the people in the economy, and they have to put it in the bank. They've got nothing else to do with the money. They can spend it, but if they want to save it, they have to put it in the bank. So the bank channels the savings, consumer savings, into investments. So the bank is fixing the investments. If the bank gets in trouble, there's no place to save money anymore, and the system breaks down. Economic growth suffers tremendously in a bank-centric system. Now, in places like the United States and other advanced countries, we have the benefit of having non-financial intermediation. And, you know, non-financial intermediation is basically savers have the right to buy securities directly or to buy them indirectly through mutual funds or hedge funds or insurance companies or something else, but they have a non-bank intermediary way to invest their savings. Now, this is good in a lot of ways. First of all, they can pinpoint more directly where their savings goes. They might decide to take more risk than their savings than they could get with simple bank accounts. Banks charge for the service of putting in deposits, as you well know. They don't necessarily pay good yields or rates of return. They might charge to move transaction balances. And so, in a lot of ways, the non-bank intermediation, also known among banking regulators as the shadow banking system, very evil, right? But it's a really good thing for economies. It's the way resources get transferred. And intermediation can happen that way. And intermediation happens another way through the use of securities, in that when consumers and firms that aren't reliable and creditworthy want to borrow, instead of going to a bank or going to or issuing their own securities, which they can't do because they don't have a reputation, they can own a credible security that's liquid and traded and use it as collateral to get a loan. So I got a minute, I could stop and tell you the old bank examiner story about the frog that comes up to the bank teller window, and the bank teller's name is Paddywhack, and Paddywhack's there, and the frog comes up, and the frog wants a loan, and Paddywhack says, well, you don't have any reputation here, or you can't get a loan. And the frog reaches into the bag, and he gives a little golden statue of a frog and puts it on the counter, and Paddywhack doesn't know what to do with it, so she goes to the bank manager and shows him the golden frog, and the bank manager says, why, that's a knick-knack, Paddywhack, give the frog a loan. I mean, sorry about that. It's an old bank examiner story that comes from the trenches when you look at books too long. But you might remember that and tell that to your children. It's kind of funny. It was very boring. But anyway, so collateral matters a lot, right? So if something happens in the financial system that shuts down things like repo markets and all that kind of stuff, it can have bad effects on the economy. But let me go back to Dodd-Frank. So if you read the rules of Dodd-Frank, and I've spent a lot of time in the last few days because I'm preparing some testimony, Dodd-Frank is really, the rules are really about granting powers and responsibilities to ensure financial stability. The problem is it never really defines what financial stability is. Instead, it talks about things like systemic risk which it doesn't define either. And since it doesn't characterize, what a state of financial stability really means, it's never really defined, then the institution sort of, the language doesn't really say what the regulators are supposed to do. Now, they're granted these powers to regulate large institutions and activities, but there's never really any clear goal about what they have to do, what they have to regulate. What is it? Was it systemic risk? It's financial stability. Well, what is financial stability? Is financial stability the absence of another financial crisis? Is that all it is? Is that all they have to present? Or does it have more to do with something else? What is a stable financial system? It has to provide growth. The economy has to grow under regulation, and Dodd-Frank ignores entirely any of those considerations. The strongest message in Dodd-Frank is crisis is job one, and here lies the fundamental problem, right? Regulators are given all these powers, the powers to regulate financial institutions and markets with very few constraints on these powers. They're written into the law, there's no review, it's very difficult to fight any of these powers, and these powers are all directed to require them to keep another financial crisis from happening. There is no counterbalancing language, like the Fed has a counterbalancing language that says you have to see that employment's strong at the same time you're fighting inflation. Dodd-Frank doesn't have that in. All they have to do is make sure there's not another financial crisis. There is no wording in there about economic growth or promoting economic growth. And so the Dodd-Frank Act takes really the approach, if you think about it, that there's good financial intermediation and bad financial intermediation. And regulators are supposed to promote the good or allow the good, but stop the bad by imposing rules. The problem here is there's not really a person or agency that I know that can really distinguish good intermediation from bad intermediation. Intermediation happens because economic agents find it useful, because it improves their ability to consume goods and services today or into the future at some point in the future. And it's really difficult to know when financial intermediation transactions are somehow bad versus good. Let me give you an example. You'll hear, and you heard President Obama, I think, even a week ago say, this excess trading in securities, this is really a sin. Financial markets and banks, they just trade, and the banks trade, and we just need more regulations. And quickly that was backtracked from the White House. But the whole idea that trading in long-term securities is somehow a bad thing and represents an excess is really misguided, right? Long-term securities, as I mentioned, can be used like the golden frog in the Piwowar joke. It's collateral for loans when the borrowers themselves don't have the reputation to walk up to the window and say, just make me a loan on my own promise that I'm going to repay you next year. If I did that to Charlie'd say, no way, you need collateral, you need some securities. And so securities trade for lots of reasons, not for the ultimate investment of them. And so there's lots of things that regulators, and banking regulators in particular, don't understand about the process, and it's dangerous when they want to regulate it. For example, repo and things like that are direct competitors to bank deposits, right? And so if you're a banking regulator and you look at those things, you say, whoa, those should be deposits in the bank. But, consumers make these judgments and do things in efficient ways. So weeding out bad, intermediation from good intermediation, it's really full of pitfalls, and it's not something that should be left to unsupervised judgment of weakly accountable regulators, especially given the conflicts in Dodd-Frank. As John said, there's no upside for them, there's only a downside. If there's a next financial crisis, then the conclusion is going to be, well, you just weren't tough enough on regulation, we need more regulations, you didn't find the bad stuff, you didn't stop the bad stuff, which may not be what's happening at all. So I think in a nutshell, besides my bad joke, that is the basic problem with Dodd-Frank, and I'll see that and come back later, but I think that's the problem that needs to be addressed. Thanks.
I've been getting confused lately. The Basel Committee on Bank Supervision is now telling us you can't regulate a way too big to fail. So they've been spending 8 years regulating a way too big to fail, and where are we going from there? And now in the United States, we have implementation of Dodd-Frank. First, a lot of the things in Dodd-Frank on regulation could have been done by the Fed without the statute. I figure the Fed must have drafted those provisions so they could say the devil made me do it. It would be a lot better if we had them in there as a supervisory role, not statutory, so we could change them, modify them. We're stuck with what we have in terms of going away. The one observation I've been having more and more is there is a difference between supervision and regulation. Supervision's qualitative, and I think what people would say is supervision failed. And so we've been dealing with it by regulation, and what's coming out of the Fed is more regulation, regulation. And regulation is black and white, yes, no. It doesn't have the qualitative, and my question is, can a better job be done on supervision? I always had more faith in supervision than regulation. I thought Tim Geithner did a good job coming up with the stress test and the CCAR. What really, if I want to just boil it down to, bothers me about the result of the stress test, the Board of Governors approving dividends and share buybacks. To me, that's socialism, pure socialism. And I guess that's our country today. Who sets interest rates? The Fed? Who tells you what loans you can make? The Fed? You want to make a leveraged loan? Oh, you know how scared banks are today of making a leveraged loan? Oh, gee, we're making a loan that's... I thought what the guidance said was, this is a leveraged loan, and you're supposed to go through all these wonderful procedures, make sure you don't have too much. That's not the way it works. Guidance isn't guidance. Guidance is a regulation that's not a regulation. And I see the CCAR and the stress test the same way. Banks can raise capital, sell assets, not make dividends, leave it up to the banker. But the federal agency approving dividend, I always thought that was the board of directors' job in what we were doing. I'll move it on. The increased capital requirements. I really don't know what. I've asked a friend a long, long time ago at the Fed, how much capital is enough? You never ask a bank supervisor that question, because they'll never tell you what it is. There's never enough. There is never enough. What I'm wondering is, we're trying to come out of a recession, so what do? We jerk up the capital requirement. Oh, we say it's a transition. There's no such thing as a transition. You're a bank and there's a capital requirement. You're going to get there faster than everyone else. You don't want to be the last one there. People want to do business with you. It may be in a real world, if we could change it, we could say, oh, we're in a recession, we're going to reduce the capital requirement. And as we come out of the economy, we're going to increase the capital requirement, and you're going to put on Fed. The buffer is supposed to work something like that. But I assume once they put on a buffer, it will be there for the rest of our lives. There'll be no qualitative judgment. But that's something that regulators could do that would be a little helpful in terms of financial stability. Liquidity and leverage. I'm thinking about this. Boy, leverage is great. It constrains institutions. Liquidity is extremely important. The job of banks is not to borrow short and lend long. That used to be a purpose of the banking system. That's gone. Borrowing short is bad. I don't know, we ought to ban demand deposits because of the risk that it all can come out the same day. At the same time, we're saying, for the liquidity requirement, you need a lot of U.S. government securities. But on the leverage side, if you have to put all of those government securities on your book, you're caught. Let's make up our minds. The last one that I find really interesting, the Fed is modeling repos for monetary policy. But, 2 years ago, there's problems in the repo market. It can't settle. There's too much risk in settlement. Well, always with the Fed, monetary policy wins over prudential soundness. A minor rant, the FSB and the G20, I didn't vote for them. Who are they to do these rules? Who picks G global SIFIs? I thought that was the biggest joke. We had the most. We won the contest. The Chinese picked one. That bank, the winner. They'll have more SIFIs, I'm sure. But it was a political joke. What is it doing? And also, I think the U.S. is saying by the actions we're taking that the FSB, even the Basel Committee and the G20, they don't count anymore. Their day's gone. They just thought that was political to make the world feel good, that leaders were doing something. It's lost steam. The VOCA rule. Well, it's good to me. I get a lot of business on the VOCA rule. I can't complain too much. But I can't, I look at private equity funds, the ones at least I deal with, not mega funds. The object there is to rehabilitate companies, get in new management, get capital, get rid of them in 5 years and show a great track record. I still have trouble finding out why is that bad? Why couldn't it have been done if we don't like things, saying, well, we can deal with it through capital adequacy? There's a huge capital charge for any equity investment. by a banking organization if we're interested in risk, and we could do it with a trading account too. You really don't like proprietary trading? Well, you can just jerk up the capital charge on it. Why did it have to be this black and white? So now we spend all our time looking to do what we lawyers do in these situations when we come up against things like that. Balkanization. Well, you know, this is the Greek hour. They're surrounded. The Balkans, we're on the edge. We're not there yet. You know, are the bank supervisors globally going to say, if you want to do business cross-border, you have to have a subsidiary, not a branch? And the English came close with a Chinese bank, but they reacted rationally and said, okay, you'll have a subsidiary bank for domestic deposits and you'll have your branch for wholesale business. And that's the way we do it in the United States. But the thought that they had to go through all of that. And I'm worried still about the Fed. You know, the Fed makes noises about branching. They want us to destroy global banking. Does anyone in the United States care if we have global banks? I remember my first trip to London, probably in the Fed, 1973. You know, I saw First National Bank of Dallas and London and said, what are they doing here? Well, I don't have to worry about that anymore. The amount of our banks that are global is really very, very, very small. I've given you leverage lending. Transparency, all I'll say about FSOC is, it's the Wizard of Oz. There's a curtain, there's a guy behind the curtain, and you know, every once in a while it opens up and you get to see what's there. The rush to regulation. So we're rush. Why isn't everything in Dodd-Frank done? I mean, we're just working our way out of it. And there's no, I don't think, any tremendous thought given to the process in terms of going forward. If I don't have more time, due process, a troublesome issue for me. We see Project Choke Point, you know, regulators just going to banks and saying, stop and do this. Enforcement. And enforcement, there's no due process in enforcement. You know, the issue is how much do you pay? It's cost-benefit analysis. It's going to cost me this much money. It's going to impact my activities in this way. I have reputational risk. If I fight, it's going to cost a lot. Legal expenses, newspapers, impact on my shares. And at some point I decide this is the cost-benefit. I settle. Everyone always settles. No one fights. When I first started at the Fed, 1968, banks used to sue the Fed. Fed had to approve an application within 90 days. Citibank Citicorp didn't think the Fed acted within 90 days. They'd sue them. First Chicago would sue. It was great. No one dares sue the Fed anymore. How can you? How can you complain? You know, I talked to a reporter about CCAR. They say, well, no one's complaining. Well, who's going to complain? One of the regulated banks going to complain about the Fed and then go through and enjoy your next CCAR. FSOC, I used to attend meetings of the President's Working Group. I thought it was a great mechanism. 10 people in the room. 2 Board of Governors, 2 New York Fed, 2 SEC, 2 CFTC, 1 Secretary of Treasury. They got together, they talked, adults, decided if things needed to be done, didn't cure the world. Now I look at the attendees in the FSOC meeting. I don't understand why 2 SEC commissioners can't get in the room. Forget it's just, there's so many other people in the room. The staff, it's an enormous number of people. What the heck's wrong with another 2 in terms of going forward? Beyond me. I was a member of an American Bar Association group on Dodd-Frank starting off. We wanted a bubble watcher. We didn't want someone in Treasury. We wanted an independent bubble watcher whose job was to put up a flag before the storm came. And we haven't got it. I mean, I can make an argument today. The Fed is creating a bubble. Who's going to do it? FSOC? The Office of Financial Research? No, you know, no way. We don't have it, and we really do need it. Last thought, and I'll keep quiet. In bank supervision, the way bank supervision should work is the regulator should sit down with the board of directors of the bank, ask the CEO to leave the room, give a tough assessment, and it'd be very rugged, and let them know what's going on. Then the regulator, the supervisor, should be meeting with the executive of the bank, the senior executives, 4 times a year. What's your business plan? How are you doing on your business plan? Are you making too much money in any? If you're making too much money in some area, something's wrong. That's the greatest warning sign, is someone's way over budget in terms of success, in terms of income. It's not just where you're having losses or problems, but more hands-on. And I would say in the old days, when I was there, that's how it worked. And what you may think is the most prestigious CEO of the times, I would say there were meetings, criticisms with the board of directors. If management is done, I don't think that's done anymore. I just think that's part of supervision. The examiner's getting that information up to the superiors in the Fed. Instead, we're on a regulatory role on automatic pilot with regulation.
Thanks very much, Ernie. And we'll finish up with Peter Wallison.
Thank you, Charles. And thank you, colleagues, for some really interesting stuff. I'm going to talk about something that has been interesting me for a while, and that is why the FSOC has the authority to designate certain institutions as SIFIs. No one has talked about this in this conference up to now, but I think it's actually the most important question that comes out of the Dodd-Frank Act and the financial crisis itself. The theory is, I think, this is why this is done. The theory is that large firms are, quote, interconnected. You will find the word interconnected not only in every news article about something the FSOC is doing, but in the statute itself. And the notion is if a large bank fails, or a large financial institution fails, not just a bank, it will drag others down with it. And so the thought was, at least when Dodd-Frank was devised, the thought was that you have to regulate these large financial institutions because if they fail, they will drag down others with them and cause another financial crisis. The actual belief was that that's what caused the financial crisis that we had in 2008. However, in social sciences, we very seldom have a chance to look at a real experiment. A lot of them are just thought experiments, and everything we've talked about up to now has been a thought experiment. But in this case, we actually have a real event that demonstrates that this theory, the interconnection theory, about what happens in financial crises and why we had this financial crisis was wrong. And that is the failure of Lehman Brothers. There's hardly anything else you can say about the failure of Lehman Brothers that was good. But in this case, the failure of Lehman Brothers tells us a huge amount about what caused the financial crisis and what didn't, and what is the value of the FSOC and its powers to designate SIFIs that we could get nowhere else. Otherwise, it would simply be a counterfactual of some kind. But when Lehman Brothers failed, in the middle of this terrible period when almost every investor and every financial institution was in trouble and looked at by the market as possibly being insolvent or unstable, Lehman Brothers was allowed to fail, a huge error in light of the fact that Bear Stearns had been rescued. The failure to rescue Lehman Brothers was a gigantic blunder. But what we can learn from that is that when a large $650 billion firm, not a bank, non-bank financial institution, fails in those circumstances, it does not drag down any other financial institution. So, what do we know? We know from that, I think, that the whole concept underlying what the FSOC has the power to do, the whole concept of designating SIFIs, is wrong. Designating SIFIs for special regulation of any kind produces no value in the sense that it prevents another financial crisis or makes another financial crisis less likely, because large financial institutions, non-bank financial institutions, banks are, I think, somewhat different, but non-bank financial institutions do not have the interconnections with one another that could theoretically bring down the entire economy. But that is what our regulators were thinking when they rescued Bear Stearns. They rescued Bear Stearns because they thought it would bring down something, and then when they failed, they created a policy, or what looked like a policy. From the standpoint of the public, it looked like a policy to rescue all financial institutions. When they failed then to rescue Lehman Brothers, the result was chaos. But it did not produce any failures among any other large financial institutions. So we've learned something really important here, and that is that the whole notion of SIFIs, the whole notion that we ought to regulate SIFIs especially, that we should designate them and know what they are, was wrong. Now, what if these interconnections among financial institutions, if that did not cause the financial crisis, what did? What happened actually, I won't go into why they were in this case. I think most of you, or many of you may know that my view is that government housing policy produced the financial crisis, but let's leave that aside. We got to a point where many financial institutions were in very serious straits because they were all holding the same assets, and those assets were mortgage-backed securities backed by low-quality, subprime, and other kinds of low-quality mortgages. When they failed, or when they came close to failure, and we had 3 or 4 banks fail, we had a couple of non-bank financial institutions, Lehman Brothers and probably Bear Stearns would have been the same, failed, that was because of something we would call common shock, or others call contagion. It was not because of their interconnections. And this is extremely important, because interconnections as a cause of the financial crisis turned out to be invalid, as we found out from Lehman Brothers. So, is it then a useful thing for the FSOC to designate financial institutions as SIFIs and regulate them and have them regulated specially by the Fed? And the answer is no, because under no circumstances can the regulation of particular financial institutions prevent common shock, or, as others call it, contagion. Doesn't do that, doesn't have that effect. And in fact, if you think about it, regulation itself creates a lack of diversification. That is the one thing that can actually prevent these kinds of breakdowns throughout an entire market. Because if the banks had not been regulated as they were, and that is, they were given advantages in buying mortgage-backed securities, that capital advantages in buying mortgage-backed securities that encouraged them to do that. And as a result, we created a very weak financial financial community, a financial system, because of the regulations we imposed. So the answer to preventing another financial crisis is not more regulation. That is more likely to cause another financial crisis. And in the specific case of whether you can regulate very large, or should regulate very large financial institutions in the interest of preventing them from dragging down one another through interconnections, there is no case to be made. It did not happen in the one case where a very large financial institution actually failed. So my proposal would be, if I were dealing with the FSOC or with the Dodd-Frank Act as a whole, the limited statement, the limited amendment that I would make is to repeal the power of the FSOC to designate SIFIs. That is a very disruptive and dangerous power, and one that will, as we could see from the Lehman case, not do us any good. So that's the lesson that I would like to propose we all learn from the Dodd-Frank Act and the financial crisis. Thank you.
I want to thank all the panelists in their presentations for being on time and being pithy and having a lot of substantive suggestions to make. Let me take a few questions now. In the back, please wait for the microphone. And identify yourself and your affiliation, please.
Hi, Joe Engelhardt with Capital Alpha Partners. I had, really two questions. The first dealt with what we were just talking about right now, but even going back to what Chairman Garrett was saying about sort of the bifurcated mind of FSOC, where they designate someone and, months or years later actually say what that means. Although I agree theoretically it'd be good to just completely abolish the ability of FSOC to designate firm non-banks as systemically important. A medium ground would be to require in the designation a much better legal standard. Right now there's just this laundry list of criteria and they can more or less do what they want. And what's missing is some kind of, as a part of that legal standard, saying you're actually going to make them less systemically important or less potentially threatening to the financial system as a result of designation. Because right now we're still waiting to find out what mediatory actions they're going to take. For instance, analogous cases where Treasury leads an agency review for SIFIs cases, they actually have to say that in approving this deal, we're going to take these affirmative steps to mitigate whatever threats are. Right now, with FSOC, there is no such, the legal standards are too loose, and they don't have to show they're making things better.
So do you have a question, though? I mean,
well, the question would be, would you support some kind of amendment requiring a better legal standard for designating non-banks as systemically important? And what would that criteria be? What would the legal standard be? And what threshold would they have to show they're actually making? I think Paul would say there is no way you can make it better, because it's a way of pointing that out. My second question is, because it came up today in some recent speeches in today's Senate hearing, the Federal Reserve is actually now asking for more power for the FSOC. They're actually focused on increasing the ability of FSOC to designate certain activities as systemically important. Some of the panelists have mentioned securities lending, repos. At an activity level basis, would that be a better alternative than designated individual firms?
Interesting. Does anybody want to start us off, taking one or the other of those?
I'll start us off. I think I know I agree, and I know Peter agrees that there's no, the standards are way vague for designation. And I think the reason behind that, and it's bad law because there's no specific goals that must be met by a designation, no standard that some goal is reached. I agree with that. But the reason behind this is the profession doesn't know how to identify a systemically important firm. There is no standard, no scientific standard anywhere that I'm aware of. There are various indexes and techniques out there that people are marketing, but I think there's huge flaws in them. And I have many academic papers on that topic if you're interested. So one of the reasons for the ambiguity is they're trying to regulate something that they can't define, and there is no objective standard, which makes it particularly difficult since property rights are involved, and the designation essentially changes the rules of the game and reduces value, and there's no due process. There's really no due process to stop it, and or one that's very truncated and not really working. So,
yeah, yes, I agree with what Paul said, but I'd mention one other thing, and that is that the standard in the statute is obviously impossible to pursue. The judgment that the FSOC is supposed to make in designating a SIFI is whether its material distress, that is something in the future, would cause instability in the financial system, which is also something in the future. No one can possibly know something like that. And the thing that the FSOC is afraid of is to set any standards, because to the extent that they set standards, they cabin themselves. They make it much more difficult for them to make the highly discretionary judgments that the statute is requiring them to make. So I see no hope for what you are expecting.
I would like to see an order. When they designate a SIFI, there should be an order, like a bank holding company approval order. It ought to lay out the criteria they used and how that company fit that criteria, and it ought to be public.
I want to just add 1 second on to Peter's to just make it more concrete about the standard. So what happens if a financial firm fails? It's supposed to cause financial instability, the distress of a firm. That's the test. But when? If it fails alone in isolation? Or if it fails when a lot of other firms fail in a crisis? Those are entirely two different standards. It is completely vague, and which one are they using? We have no idea.
Yeah, I'd like to say that, and again, these are my own opinions, that certainly transparency and objectivity are good things. If you're going to have a rule, you ought to have standards for making that rule. I'm not quite sure why people are just focused on non-bank SIFIs. I think the same thing ought to apply to banks. There's a lot of Dodd-Frank that's based on having $65 billion worth of assets or something similar to that. Balance sheets I don't quite think are relevant. If Peter is correct, and in fact contagion is the issue, contagion is a function of assets under management more than anything else. There's certainly non-bank financial institutions that vastly dominate in terms of assets under management, and if that's the potential source of issues. Citi has on the order of 2.5% to 3% of the value of U.S. dollar payments in the system every day. That's pretty strange standard for being systemically important, having 3% of something.
Since nobody responded to your point about activities as a basis for the designation, I want to make a very brief response, which is another way you could think about activities is how much does each firm contribute to system-wide liquidity risk. So you could decide to create, let's say, a safe harbor that would say, if your institution is funding itself with, let's say, 0 repos and no other short-term debts, maybe you would be exempted from SIFI designation, or so long as your liquidity risk and your contribution to potential liquidity risk was sufficiently low, you could be exempted. I'm not advocating that, I'm just saying that would be an example of a reasonable argument that some people have made. Let's take some more questions, though. Bert's had a chance, but if there's nobody else, Bert?
Charlie, you can always count on me to ask a question. I want to pick up on something that Peter was talking about in terms of contagion, and that is, to what extent has a certain accounting rule, mark-to-market accounting, made the contagion problem worse, or created contagion where absent mark-to-market accounting and all of the consequences that come from that, you wouldn't have contagion and the multiplicity of institutions that might fail because of problems that are initiated in just 1 or 2 institutions.
Yeah, if I can, I'd like to take because I agree completely.
Brief so everybody can
Yeah,
shot at.
I agree completely that mark-to-market accounting exacerbated the problem of contagion terribly, because as these mortgage-backed securities were marked down, others were required to do the same to mark them down. The market was similarly frightened. All the buyers pulled out of the market. The value of these things went to near zero or to some very low distress number, and that affected every one of the financial institutions. So when we talk about contagion, we have to talk also at the same time about what mark-to-market accounting did.
I think it's the concept of mark-to-market, not mark-to-market accounting. Banks don't have mark-to-market accounting on the investment portfolio, but the market decided that it could market. So I think during the crisis, most major banks were well capitalized under traditional accounting.
I'm not sure mark-to-market accounting is necessarily a bad thing. I think discontinuities in parts of the balance sheet being subject to mark-to-market account and other parts of the balance sheet not certainly are a problem. I would suggest that the Japanese had a banking crisis some years before 2008, which was manifest from not having mark-to-market accounting. So I think there's probably mixed evidence in that regard.
At this point, we will end the Q&A part of the program, and go into the final activity of the conference. I don't know whether Alex has taken a break, but Alex and I agree that we try something new, which we've never tried here at AEI or anywhere else, which is try to collect up some of the ideas that are on the table and ask people, and we won't hold you to this forevermore, but to express their support or lack of support for some of these ideas, just so we can see whether we've actually made any progress in establishing consensus on some of the ideas that have been offered up today. So what I'm going to do is quickly go down the list of, I've now got 7, which is way more than I hoped I'd have, but 7 interesting propositions. I'd just like people to express support or lack thereof for this. So if you raise your hand, that's support, and then you can also express lack of support by raising your hand subsequently. Okay, first question. This relates mainly to the keynotes that we had. Alex, we've already started the voting process. Is the proposition that more sunshine and the ability of to attend by, let's say, SEC commissioners, governors of the Fed, and similar kinds of regulators would be desirable reforms of the FSOC. Making the FSOC more. Raise your hand if you agree with that. Okay, now please put your hands down and raise your hands if you don't agree with that. Okay, we have at least 1 or 2 who don't. Next question. Establishing to the, if we're going to have SIFIs, establishing clear criteria for what constitutes a SIFI. Raise your hand if you agree. Okay. Raise your hand if you disagree. All right, I think we have consensus for that. No, we're transparent, okay? We're actually seeing the voting. Okay, the idea, and I know that we didn't specify it in great detail, but Jerry Caprio's, and I guess also Alan's idea of a sentinel, some kind of authority that would be able to oversee not very transparent processes and would not be a regulator, but would have access to information and play a disciplinary role on the regulatory process. Does that sound like something appealing? Okay. Raise your hand if you're against it. Okay, I think we have a slimmer majority in favor of that than on the prior ones, but still a majority. Adding, following up on Asla's idea, adding to, let's say, the World Bank and the IMF's mandate in its FSAPs and other such activities, it's what she described as an incentive audit of holding accountable and examining the incentives of the regulatory process, ownership, etc. Raise your hand if you're supportive of that. And raise your hand if you don't like that. Again, I would call that a majority, about the same as the prior one, but a slimmer majority than the first few. Now we turn to Ernie's proposition that as part of the outcome of the stress tests, it shouldn't be that normal banks should be subject to micromanagement of their dividends, although capital might be required to be increased and other things for the bank as a result of the stress test, but not the micromanagement of decisions like dividend payments. Raise your hands if you agree with him. Okay. Raise your hand if you disagree with that. Okay, I would say a larger majority once again. John Davidson's universal registration proposal. In particular, let me make it concrete. If you're involved in FX and swap transactions, you would be registered just as you would if you're involved in pork bellies. Can I put it that way? Raise your hand if you disagree. I would say we have a majority for that one. And now we get to Peter Wallison. Repeal the SIFI designation power of the FSOC. Okay, and now don't do that. Raise your hand if you are against that idea. Again, well, this has, of course, some people have abstained, I'm sure, but we obviously only invited people here today who all agreed with each other. So,
Or they were the only ones who stayed.
what did you say? Yes. Well, that's a very interesting point. Anyway, I want to, at this point, along with Alex Pollock, my co-organizer of this, thank all of you for coming, and maybe you can all join us in thanking the excellent panel that we just had.